All right, let's see. Hey guys, how you doing today? Welcome to the channel and welcome back to another video. If you're joining me on Facebook, good to have you. Joining me on YouTube, good to have you. Joining me on LinkedIn, good to have you. Joining me over on Instagram, good to have you. Appreciate you guys being here. Today, I want to have a conversation about Nvidia, about the possibility of the Fed doing a emergency rate cut. Perhaps. We don't know. We'll see, right? Something that's being talked about, something that's being kind of knocked around right now. It probably won't happen, but we're just not sure because the Fed could come in and do a rate cut on an emergency basis, right? So we're going to talk about the fact that Nvidia, that stock is going down, 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 along with other stocks. And the question is, should the Fed come in and do a emergency rate cut? Sell-offs are all over the place. So I'm glad to have you guys here. If you can hear me, give me a thumbs up. If you're not watching on YouTube, you can go over to YouTube at Smart Money Bro on YouTube, because over there we're going to be sharing our screen a little bit and pointing out some things. So let me know where you're coming from, what city, what state, what county, country, and give me a thumbs up if you can hear me, guys. But the stock market looked ugly, and I mean real ugly today. Really, really in the red. Down, down, down. Everybody's getting emotional. Everybody's stock who invested in Nvidia in the last few months, they see it slipping. So there could be a cause for a little concern for some people. Some folks that bought Nvidia at 130, 135 per share, and we saw it dip it for a hot second. It dipped down to $92 per share today, right? So it's slipping. Some folks that are panicking, some are not. Got a couple of emails today. So I know that some people are wondering what's going on. Guys, do me a favor as you come in here, hit the thumbs up button. Just smash that like button for me. Before we get jumping and get started, guys, make sure you feel free to go over to Instagram, follow Smart Money Bro over there, and just give me a shout over there. I'm trying to grow that Instagram a little bit. Let's see here. Much love from Canada. Good to have you, Ray. Tim, good to have you as well. Yeah, rough day in the market. Absolutely. Let's see here. Hey, Validated, good to have you here. Bay Area is in the house. Listening from the car. Brian, good to have you from Phoenix. Canada's in the house again. Mrs. Moore, thank you so much for being here. I appreciate you as always. Much love from Martinez. Where's Martinez? I wouldn't consider it's a crash necessarily. South Holland, Illinois, right outside of, actually right there in Chicago, right southwest of Lakeshore Drive a little bit. Walla Mala's here. Good to have you here. Alabama's in the house. San Diego's here. Sherlock is here. Tim G, as you guys know, on Mondays, I like to kind of give us a kind of let the week get started with the stock market, and then come in and talk about it a little bit, have a little bit of validation in terms of what's going on for the day and where we could see things going for the week. Baltimore, Texas, Arkansas is here as well. Appreciate you guys. Hey, Renita's here as well. Namisha, good to have you. Corey as well. So again, you can also go over to smartmoneybro.com and check us out over there. We got some stuff over there. We got some free stuff in the description box below. 24 Laws of Money. Feel free to take a look at that. It's a free ebook. And check out the first link in the description box below. You'll see Mint Mobile here on YouTube, which is my partner for this video. Partnering with them. Feel free to check them out. Super duper easy to use. Excellent premium wireless services. So also check us out on Patreon as well. There's a link to that. So Nvidia, we're going to talk Nvidia. We're going to talk stock market in general. We're going to talk Fed funds rate. There is talk. We've seen some articles today about the potential for the Fed to go ahead and cut that Fed funds rate that has been hovering right at 5.25% and 5.5% for the last year. And they've held steady. And many people are saying that the Fed held steady too long, right? Too long. But the Fed has come back and said, hey, wait a minute. It's been we don't want to cause inflation, because when you lower rates, that's inflationary, right? So let's start with Nvidia, guys. Let me go ahead and pull up Nvidia real quick, and we'll share my screen with you real quick. If I can share my screen, I'm getting there. Let me go ahead and share it with you, and we can see what happened to Nvidia today, in case you weren't paying attention to the market, because there's some folks that, hey, I got it in an ETF, but I'm not going to sit there and watch it every single moment of every single day, right? So today it closed at $100.45, down a little bit. Now, look at that line right there, guys. And if you're not over here, feel free to go to over to YouTube. Look at that line right there. 9:30 this morning, Nvidia had dipped down to $92. Now, on this channel, about what, 3 or 4 weeks ago, we said, wow, if Nvidia gets below 100, it'll be a buying frenzy, right? For a hot second, it dipped to $92.01 per share. Super duper low. Quite a bit off, I think down 20% from its high of about 135, 138, whatever it was a few months, about a month ago. For the last 5 days, there's our chart for the last 5 days. And I think I'm sharing with you guys. Let me see if I'm sharing right. Let me get out of the way and put myself in the corner so you can see that a little bit bigger. But it's down, right? Nvidia is down. Look at the month over month, right? Peaked in the last 30 days, it peaked at $134.91. Today is trading down. It's ended today at a little over $100. So I know some of you are panicking. I know some of you are like, oh my goodness, what's going on? Because I dropped $30,000, $50,000, $70,000 into it, right? But a stock, okay, let's talk in general. Like the stock market in general is down, right? If we show charts of any of the indices, but whether it's NASDAQ, whether it's Russell 3000, whether 2000, whether it's S&P 500, everything is pretty much down for the most part, right? Some people are saying, oh my gosh, get ready and brace for a stock market collapse. That could happen because we're overdue for a stock market collapse, so to speak, or a crash, right? Now, is the current market overheated? I would say yes, it's a little overheated. Is inflation starting to rise? It's not really rising, but it ain't going down to where the Fed really, really wants it. It's close though, and the fact that it's close is one of the factors why people say, well, the Fed ought to just go ahead and cut rates, right? You're at 2.8%. You want to get down to 2%. Let's go ahead and stimulate the economy a little bit. And how does the Fed stimulate the economy? It lowers the cost of money. And when it lowers the cost of money, it makes people go out and borrow money. Not just people, but businesses go out and borrow money. So market speculation is ramping up. People are being much more speculative. Now, I'm going to do this again tomorrow, because tomorrow I want to talk about, is the stock market overvalued? Are we in a sort of a small little bubble? And I want to really hit on that a little bit later. Probably tomorrow I'll hit on that. But there's a lot of uncertainty right now. The stock market hates uncertainty, right? The stock market does not like uncertainty. We can look around the globe, and this is, they're talking about what happened in Japan may have sparked what we see over here in terms of some fear and some sell-off. But the global market is really saying that earnings are too high and volatility. Look, there's volatility indexes out there. I'm not going to dig too deep into that, but when you look at the volatility indexes, you see that it's a clear indication that there's some type of overvaluing of the stocks that we have, right? People are expecting, investors are expecting too high of earnings, and the market is saying no, 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 no. So I think it's going to be a rocky couple of days, few days here, guys. It could last a week, could last a month. I don't know. If I did know that, I'd be the man, but I don't claim to know that. I'm not telling you that I know anything. I'm just giving you information, because on this channel, it's about us being informed investors, right? So I'm not going to recommend a stock for you. I'm going to tell you, hey, do your own research, right? But we got to be clear. It's a global market right now. And what happens in, Japan could affect us, right? What happens in other markets in other countries have an effect, possibly. And today is a good example, right? The question is, are you buying Nvidia at these prices around the 95 to 105 range, right? Is that sort of your strike price, so to speak, right? Is that where you say, man, if it goes to 90, or you saying, wow, if it goes to 70, we just don't know. The other thing we don't know is this the beginning, or is this sort of a one-off couple of weeks, a one-off 3 or 4 weeks, right? The question is, and I mentioned this before, is that Nvidia is going to go the way of the AI revolution, right? If this AI thing is going to kick off like everybody thinks it will, that is what that is what Nvidia is going to sort of trail, right? Or sort of follow, so to speak. Let's see here. I like to go to the chat, guys. Let's see here. They lost over 2 trillion today alone. Wow. Wait, 2 trillion? Are we still boom, boom, boom? If I was retiring the next couple of years, I'll be heading for treasury bonds. Yeah. Great point, Panama Jack. I appreciate you saying that. I'm gonna highlight that chat because it makes a lot of good sense, guys. Panama Jack said, if I was retiring in the next couple of years, I would be heading for T bonds or treasury bonds, T bills, what have you. As a short term investor, right? We know the market goes down, up, down, up, down, up, down, up a little higher, down, up a little higher, down, 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 up a little higher, right? So ultimately, if you're looking for your money in 2 years and 3 years and 4 years, you may not want to be playing these volatility games that we're looking at, right? And that's why I think I had somebody contact me who was in their 60s and they said, I put all my money in Nvidia. I said, wait a minute, careful with that. You're in your 60s and you want to chill. Are you sure you want to take that risk in terms of a short term and looking at some of the short term volatility? Keep in mind, tech stocks in particular, Nvidia is a tech stock. Tech stocks are cyclical, right? They don't just go up and up and up. And what we saw with Nvidia for the last I don't know, year over year here up until maybe a couple months ago is very, very unusual, right? Very, very unusual. So keep that in mind, guys. But is this the end of the tech bull run over the last 3 or 4 weeks where we've seen the tech sell off? Is it the end of the tech bull run? Is it just massive fear or panic, guys? Let me know what you think in the comments here. Let me go through them and see what you guys got. I'll be buying the whole way down, said Breeze. $70 per share, and I'm all in, said Validated. You're going to wait until $70 per share. Okay, I'm not mad at you. Somebody said, how will this affect your TSP or 401k? Great question, Trey. I'm going to answer that real quick because I think a lot of people are thinking about that. So for you guys that don't know, a TSP is a thrift savings plan. And it's usually for people that work for the federal government, U.S. federal government, right? TSP. And inside of the TSP, like many other 401ks, but specifically TSP, you have these different buckets: the C fund, the F fund, the G fund, the S fund. I think is there an I fund or whatever? You have these different buckets. So these are like mutual funds or low cost index funds, is what they really are. And so you hold some Nvidia in that bucket. If you have the C fund, you may hold some Nvidia in the bucket like a low cost index fund or a low cost ETF. You hold a portion of what's in that bucket, whatever fund you're invested in your TSP, C fund, F fund, G fund, whatever. And so you won't hold Nvidia in the G fund or the F fund, right? That's just an example because those are typically fixed securities, right? Bonds and so forth. But in the C fund, the S fund, those you'll hold a piece of Nvidia in there, just like it was an S&P 500 index fund or S&P 500 ETF. So how will it will affect it? It'll have some effect on it, obviously, right? But not as much as if you owned it outright as a single stock, right? Same thing depending on what you have your 401k invested in, right? All right, let's see here. I hope I answered that question. Let's see here. AI revolution has been delayed, somebody thinks. I don't know. Let's see. Somebody says I'm dollar cost averaging in. Guys should have placed puts on tech. Yep, absolutely. You could have made a ton of money if you placed puts on tech. Absolutely. Beautiful sunshine. I'm still going all in Nvidia. Just kind of read through the chat, guys, and seeing what you guys are saying. In my humble opinion, this is obviously, guys, we have to look at this as investors as an opportunity, right? Rather than trying to catch a falling knife, right? Instead of trying to catch a falling knife, look at this as an opportunity, right? Don't rush to get angry. Don't rush to panic. This is a buying opportunity, perhaps, for savvy investors. And if you're a new investor, I know we got a lot of newer investors here on my channel. If you're a newer investor, understand that this is an opportunity to take advantage of things that could be on sale. Now, here's the kicker. Well, I won't get into that yet. We'll talk about it in a second. Look at the earnings, guys. Look at demand. Demand for AI. Is the demand going to be there for AI moving forward? Or I think I read somebody in the chat said it. was this sort of a fluke for AI over the last year or so, right? I think the demand for AI is there. I don't think the demand for AI is going away, right? I think it's there. It's going to be there, right? Let me take a look at something else, guys. Let me pull up my screen real quick. I'm going to look at another article I ran across that I thought would be interesting to talk about real quickly here. Why the stock market is freaking out again. Let me see if we got. All right, good deal. So fear has set in on Wall Street, and stocks are having another miserable day. This is today, by the way. This is an article from CNN. All of that comes amid a global market sell-off. All right. Japan's index nosedive 12%, its worst rout in history. One of its indexes. All major Asian and European markets fell substantially today. Three fears are emerging all at the same time to send markets into a tailspin today. Growing worries about a recession, concern that the Fed has failed to act quickly enough, and a belief that big bets on AI may not pay off. That's why I asked the question. The most prominent is fear that the U.S. economy is in much worse shape than previously believed, evidenced by the unemployment rate that went up on Friday. There was an unemployment. We'll talk about that in the brief, but there was an unemployment rate or unemployment. The Bureau of Labor Statistics came out with their unemployment rate for July, and that sucker went up. It went up above expectations. And so that's what the Fed expected to happen about a year ago, right? But because of lag time, it takes a while for their policies to actually show up in our regular everyday life. And it's starting to show up with an increase in the unemployment rate. I think it was the highest in the last year and a half, 2 years or so. On Friday, the Bureau of Labor Statistics announced the U.S. economy added just 114,000 jobs, far fewer than they expected. And the unemployment rate jumped to 4.3, although that's not in and of itself an unhealthy unemployment rate. 4.3 is pretty low, right? Its sudden march higher is a little bit alarming, right? Last year, the unemployment rate was its lowest level in 50 years, right? So it's going up slowly. To be clear, the U.S. economy remains pretty strong. Last quarter, it grew way more than expected, boosted by still robust consumer spending. We're still out here spending, right? Even though we see, inflation hasn't come down as fast as they wanted to come down to the 2.0% target rate, right? It says, but recession fears are starting to mount. Goldman Sachs economists on Monday raised the odds of a recession to 1 in 4 in the next 12 months. A recession, 2 straight quarters of a down GDP. That's the textbook version of a recession. And it says that's still a limited case because the economic data still looks strong overall. But Goldman's recession chances are still 10 percentage points higher than they were before Friday's jobs report. So the jobs report kind of sent shockwaves sort of in our economy, at least, right? So we'll talk about the Fed, but the stock market had hit a record after record high this year. We know that, buoyed by falling inflation and the growing sense that the Fed would shift its series of aggressive rate hikes and start to cut rates. But the Fed has not cut rates. That's the kicker, right? The Fed has not cut rates. That's the problem. And I say problem because it's causing everybody to say, wait a minute, Fed, what's going on? Why haven't you cut the rates? Right? Why haven't you cut the rates? So this stock market downfall that we see is not just affecting tech, guys. It's affecting the entire market. All right? The entire market. We have a lot of volatility, right? A lot of volatility. There's a lot of concerns going on right now, not just economic data, right? Not just because the job market looks different, right? The unemployment rate starting to go up, right? And when people see the unemployment rate starting to go up, it changes consumer sentiment, right? How we feel, right? If we can turn around and say, hey, the inflation, that makes the consumer sentiment, light some light bulbs and say, wait a minute, something's wrong. And also the unemployment rate, right? That fuels a lot of speculation. Not to mention there were several companies, guys, that reported earnings in the last week or two that missed their earnings expectations. And when a company misses their expectations, that's cause for concern in terms of investors as well, right? And it's made a lot of these companies, they made their stock prices go down, right? MGM, I think I looked at Moderna, right? You looked at some of the Max 7 companies, right? Didn't quite hit their targets, and that's always an issue. We know tech and semiconductor sectors, which are sort of both tech, but both also relying on AI, those have been incredibly volatile, right? And they've been hit hard. If you look at the Max 7, Max 7's all down, right? All down. And of course, as I mentioned, you got these international markets that's having their issues and problems as well, right? All these things are leading to some issues, right? We know Nvidia is just one stock amongst many that are having its share of issues right now, right? The stock market is experiencing a downturn, right? Yeah, we got bonds rising, higher yields. We got concerns over in China. We got concerns in the Middle East. We know what's happening over there. We got a recent downgrade in the U.S. credit rating, right? We got a lot of things going on right now. We got a presidential election that's coming up that everybody's on edge about, right? And then we have this Fed with its policies that said, well, we're going to be cutting rates. Everybody thought they were going to be cutting rates 3 or 4 times this year. It could still happen, and it probably will with this latest information. But has the Fed held off for too long is the question. Appreciate you guys in the chat, man. You got some lively stuff going on there. But bear market, perhaps. Bear market, perhaps, right? Bear market is when the index or the primary index that we look at, like the S&P or it doesn't matter. It doesn't have to be the S&P. It could be any of the indexes, right? NASDAQ, whatever. But when they fall by 20% or more, that's considered a bear market, right? It's just a period where they drop drastically and significantly. And what happens? Our overall investor sentiment, how we feel about the market, goes negative, goes pessimistic, right? Super pessimistic, right? So unemployment rate. Let's talk about that real quick because that was a big issue, right? I think I listened to something today where the Fed chair from Chicago's district, the Federal Reserve is broken into 12 different districts around America. The New York Fed is always the Fed chair. Now, I don't know exactly why that is, but whoever's the head of the New York Fed is the chair. It happens to be Jerome Powell right now, right? But the chair of Chicago, he said, "Hey," and he gave me an indication that said, "You know what? Maybe we need to talk about this tonight on this channel." Based on what I heard him say today, he said, and I think I'll bring it up, see if I can see where he said it. I don't know if I can find it or not, but he said we've been overly restrictive. And he said that the data does not show that we should be overly restrictive. I'm paraphrasing him, right? Don't quote, I'm not quoting him, but he basically said that the data is not showing that we should still be as restrictive as we are, right? He said and he mentioned this, there's a rise in delinquencies and consumer defaults. And when there's a rise in delinquencies and consumer defaults, right? That basically means there's a rise in people paying their stuff late and a rise in no pays, people that don't pay at all. When that stuff starts to rise, that's a red flag to the Fed that should tell the Fed, wait a minute, things are not as affordable as they should be for more and more and more and more people. So that should tell the Fed, let's ease up on the price of money, how much money costs to borrow. Let's ease up on that, not only for individual consumers, but also for businesses, right? And so these are the types of red flags that he pointed to when he was having an interview. And it said to me, wait a minute, now, should the Fed go ahead and do this thing quickly, right? Now, the stock market has priced in rate cuts coming in September. and possibly beyond. I think in beyond that, they priced in that there might be 150 basis points cut by the end of the year. 150 basis points is 1.5%. Right now, the Fed funds is at 5.25 to 5.5%. That's where it's been for the last year. And again, Fed funds rate is the rate that banks loan to one another overnight. Those are really short term, 1 week, 2 week loans, but they pass that along to the cost of what they loan money to us at, right? So when the Fed funds rate goes up, that means when you go get a loan for a car from that bank, instead of charging you 5% interest, they're going to pass along the fact that they're buying the money for more. So they're going to charge you more to borrow it from them, right? So instead of your 5% loan to get that automobile, they're going to charge you 7% because you're going to feel the brunt of the Fed raising their Fed funds rate. And so that's why it's important that when the Fed funds rate goes down, now the banks borrow each other's money at 4%, and they're only going to charge you 6% for the loan for the automobile, whatever. That's what I'm saying. So they're pricing in a 1.5% increase, or sorry, decrease in the Fed funds rate in the next several months before the end of the year, right? But the stock market, again, the stock market is forward looking. So it's trying to price in what it thinks the expectations are going to be, right? He also said that if conditions deteriorate even more, there's a chance that he didn't really say it like that. Okay, I'm paraphrasing, but he gave the indication that there could be some type of emergency cut before the Fed is scheduled to meet again in September, right? We know that, look, matter of fact, the Fed kind of indicated in a couple of meetings ago, the Fed indicated that, they were waiting, as always, every meeting they say, we're waiting on that 2% inflation rate. We're standing strong that we're going to get down to 2% before we do anything with the rates. They also pointed to the fact of employment, right? They're watching employment. Well, employment shot up from 4.1 to 4.3. So if it shot up from 4.1 to 4.3 and the core PCE is down to about 2.8% as opposed to the 2%, you're getting closer and closer to what you want in terms of higher unemployment, Fed funds coming down. What are you waiting on, Fed? That's what everybody's saying. What are you waiting on? Right? You're 90% towards your 2% target rate. What are you waiting on, Fed? And the interviewer went back and forth with the Fed chair from Chicago and had that conversation, right? But they said in the June meeting that they possibly would move, and they haven't moved, right? The question is the Fed taking too long to move the Fed funds rate down, to decrease the rates? All right. Are they being too restrictive for too long? Super duper important because it's starting to affect the markets. The market is starting to feel some pressure here. Remember, when the Fed lowers the rate, the Fed makes money cheaper to borrow. That means businesses now can go buy that piece of equipment, now can go spend more money, right? Consumers can now go spend more. It sort of stimulates the economy a little bit when the Fed pulls that Fed funds rate down, stimulates spending. And some people call it inflationary because it causes demand to go up and that causes prices to go up. So the Fed obviously is playing a balancing act, of course, right? But they're basically at the target of 2%. So they could be being too restrictive for too long. If the Fed doesn't do anything until September meeting, the market could continue to slump and slump and slump and slump. The market likes good news. When the Fed indicates a rate cut or a rate cut comes or the Fed goes ahead and cuts rate, the market reacts favorably, right? So, you know, we had a really weak job report. When I say weak job report, the weak jobs report showed unemployment going up, right? And it said also, let me read this because I should show it on my screen here. The hiring rate had failed to a level that was prior to the pandemic, right? And only adding 114,000 non-farm jobs is pretty low, guys. Pretty low. In June, America added 206,000 non-farm jobs. So in July, you almost split that in half, and you got less new non-farm jobs being available, right? And they were expecting an unemployment rate of 4.1 or 4.2%. They got 4.3. So it's just added to the worries, and it's added to the speculation. It's added to the pessimism, right? Added to all of that. And then, of course, wage gains. And I won't go too deep into wage gains, but wage gains are outpacing inflation. The issue with wages, you always want to watch wages when you listen to the labor reports or whatever, because the wage rates matter, right? Wage rates are important, right? Because inflation, if people's wages are increasing slower, I don't want to get too. I'm going too deep. Let me stop. Let me slow down. Let me go back to the chat, guys, and see where we are. We got more to talk about. Let's see. Smart Money. Can you speak on the fact that people are losing jobs left and right? If people have no jobs or forced to sell homes, there won't be an influx of qualified buyers. That's a problem. Yep, that's a really big problem. Jeff, I think, asked that question. That's a really, really big problem, right? The fact of people not having jobs. So if for some reason, August, September, October, if we see the unemployment rate go to 4.5, 4.75%, that could be a very, very big issue. Very, very big issue, right? You are going to coming up, because I think we're going to see the job rate, the unemployment rate continue to increase, right? I think we're going to see the unemployment rate continue to increase. Hiring rates are slow. Hiring rates are much lower than they were before, right? So if you 2 or 3 years ago, you're looking for a job, there were a lot of jobs out there, right? That's not the case. That's not going to be the case moving forward, right? So that's something to think about. When jobs are harder to find, what happens to household spending? When jobs are harder to find, people are spending less money because they're worried, right? Even though you might be lowering the cost of money, or the Fed funds rate, and incentivizing people to get out there and spend. Why would they get out and spend if they have less money coming into the household because of increasing unemployment rate, right? When jobs are harder to find and unemployment goes up, that weakens the economy. No matter how low you put the Fed funds rate, it weakens the economy as unemployment rises, right? Unemployment rises, people spend less money, even though money is cheaper. And so I think as we see over the next few weeks, few months, as we see unemployment go higher and higher, it'll be an interesting juxtaposition on how that fares with lowering of the Fed funds rate, right? Things could get a lot worse. Unemployment at 4.3% is still very low. But unemployment at 6.3%, that's a huge issue, right? That's a huge issue. Remember, the Fed cuts rates to stimulate business activity and consumer spending, right? Because we can borrow money at cheaper rates. But if ain't nobody working, or I say ain't nobody, but if a lot of people aren't working or they're losing their jobs constantly, it's not going to matter how low the rates get, right? So this is a balancing act. So Jeff, thanks for that question. Appreciate it. Let me just kind of run through the chat here, guys, and see what you got. I think 2% in 2024 is asking a lot. 3% should be normal. Let's see here. 3% is the new normal there. All right. I can't bear to look at my brokerage account. Namisha, I understand. Lots of folks are feeling like you. I don't want to look. right? Anybody else in the chat said, I don't want to look today. I know it ain't good. I don't want to look, right? I'm trying to hold on for the long haul and I don't want to look, right? I know a lot of people are in that situation, Namisha. Absolutely. No, I'm not going to look. Let's see. Somebody said, I hope the best for everyone here. I know everyone invested in Nvidia. Let's not give up. Absolutely. Beautiful sunshine. That was a comment straight from your name. Beautiful sunshine. Said, I hope the best for everyone. Listen, guys, a lot of folks that watch this channel, they have invested in Nvidia. Totally understand it. But you got to remember, it's a long game when you invest. It's a long, if you plan to jump in and jump out and sell and buy low you're gonna be doing something that 90% of all professionals who've been doing this for 20 years can't do. Picking the right times, right? Always jumping in, jumping out. It's a long haul, right? If you're in the stock game, individual stock picking, it's a long haul. Now, if you have ETFs, index funds that include Nvidia and some of these tech stocks that have really shot down, or stocks in general, you're probably feeling a lot better about your decision not to jump on Nvidia at this point. But don't give up on the fact that AI is very well could be at the beginning, right? Should the Fed cut the rates immediately? Let's talk about that. Should the Fed do an emergency cut? Should they do an emergency cut? This is the question. Let me actually pull this up real quick, guys. Let me share my screen with you real quick and pull up something. Let me take that off. Boom, boom. I want to take a look at something real quick. Another article I ran across, if I can find it. Here it is right here. Could the Fed enact an emergency rate cut before its next meeting? When is Fed's next meeting? Let me see. Fed's next meeting is going to be September 17th and 18th. So just about a little over a month, about 6 weeks or so, or a little bit less, is when they're going to have their next meeting. Could the Fed enact an emergency rate cut before its next meeting? Here are the odds. This is today's article from the day on CBS. The 3-day stock market rout roiling Wall Street is prompting some experts to question whether the Fed could enact an emergency rate cut before the next meeting. The speculation is arising in the wake of Fed's July 31st meeting, when the Fed decided to keep its benchmark, the Fed funds rate, steady at its highest point in 23 years. Keep that in mind. Banks are borrowing money from each other right now for overnight lending at the highest rate they've been doing that since 2001, right? The Fed funds rate has not been this high since 2001, and it's been this high for the last year. Fed has not changed it in 1 year, right? Says, and this is why we see, mortgage rates and things like that that are higher than what we're accustomed to in the last 10 years. At a press conference that day last week, the Fed Chair Jerome Powell said while he and other officials were carefully watching the labor market for signs of weakness, they wanted to see more evidence that inflation was cooling before cutting rates. Well, you've got your signs of weakness right now because we just saw the unemployment rate shoot up to 4.3%. Said, but on August 2nd, the monthly jobs report came in much weaker than expected, sparking fears that the U.S. economy may be fraying under the weight of high borrowing costs and that the Fed has waited too long to cut rates. A few other weak economic reports have added fuel to those worries about the economy, igniting a 3-day rout that has caused the S&P 500 to shed 6% of its value. Given the dim economic output or data, some analysts and investors said they believe the Fed should undertake an emergency cut before their next rate decision. Some analysts are even suggesting an intra-meeting emergency cut is warranted. What are the odds? Traders are signaling a rough 60% likelihood of an emergency 25 basis point cut within the week. Emergency 25 basis point cut is 0.25 of 1%, so 1/4%, right? 60% chance is what they're talking about today. And I think the talk is going to pick up tomorrow as we see what I think is going to be some more sell off in the market and some more downturn in the market. It says, but some experts said they believe the odds are much lower, noting that overnight index swap rates implied that investors saw a roughly 30% chance the Fed could make an emergency cut. And here they're talking about Chicago, right? The guy I heard today. Chicago's Fed President Austin Goolsbee on today told CNBC that if there's more deterioration in economic conditions, we're going to fix it. That was the term he used that I was looking for earlier. We're going to fix it, right? We're going to fix it. What does that mean? That means perhaps an emergency rate cut. It says the Fed has cut rates at 9 emergency meetings in the last 30 years, which means an intra-meeting cut before September would not be overly unusual or unprecedented, right? The last time they did that was in March of 2020 when the economy was free falling due to the pandemic, right? The pandemic happened, everything shut down, people weren't spending. So what did the Fed go in and do? They hurried up, did an emergency meeting, and they said, we're going to cut rates immediately. Again, because cutting rates stimulates the economy, makes people go out and spend, makes businesses go out and spend. So the beginning of the pandemic is the last time they did one of these to get people to get out and spend, right? It says intra-meeting cuts have only typically happened in the event of a financial crisis, which are we in a financial crisis right now? Not necessarily. Not necessarily, right? It says while the markets are pricing in the chance of a rate cut, many economists believe the Fed is likely to wait until its September meeting in 6 weeks to start easing borrowing costs, partly as the S&P 500 and the Dow Jones currently they remain in positive territory. Guys, if you look at the S&P 500, the S&P 500 is still up, I think 9 or 10% for the year. So can you really constitute this being something of emergency if the S&P is still up 10% for the year? Probably not. It says, somebody said in quotes, we think Powell will opt to wait until September, provided markets stabilize, which is Pantheon's economist wrote in a research note. The Fed probably will place little weight on the drop in stock prices as the main indexes still are higher than at the start of the year. Again, if we saw, listen, they didn't do an emergency rate cut when we saw the S&P drop, and for the year, it ended at like negative 19% in 2022, right? So I think while we out here, retail investors are like, oh my gosh, oh my gosh, oh my gosh, I'm not sure the Fed sees it as an OMG moment like some of us do, right? So I just want to share that quick uh, article with you guys to say that it's being talked about, right? But the question is it going to happen? Is there going to be an emergency meeting to cut rates? I'm not sure I see that. Listen, my portfolio is down, and I know your portfolio is probably down too, right? So, I mean, everybody's hurting, but listen, don't look at this as hurting. When you see the stock market go down, don't look at this as hurting. Look at this as the dress is on sale on the sales rack, or the shoes are on sale on the sales rack, or the suit that was $1,000 is now on sale for $750, right? Look at this as buying or opportunities for you to learn, for you to understand, for you to evaluate, for you to practice not panicking, practice being patient, because these things happen all the time in the market. You just got to know that, right? But you don't want to be sitting in front of your screen all day, every day, watching markets, doing your stock watching. And next thing you know, you're in a panic. Oh my gosh, I put in 20,000. This is why I always say you only invest money that you can afford to lose. You don't just you don't invest money that you're going to, pay the rent with. You invest money that you can afford to lose if something goes crazy in the short term, right? Hey, Jeff, thank you for being here. Appreciate that. Let's see here. Cheap tickets to the moon, said Dastardly. Absolutely. Palantir came out with a happy earning report today. Absolutely. Palantir, if you don't know Palantir, guys, Palantir is a stock I think they're trading about $23, $24 per share. Palantir did a whole bunch of government contracts back in the day, right? Now they're trying to move into this commercial space, and they only trade at $23, $24 per share. Palantir is not a bad one. Thanks for bringing them up. They had a pretty good earnings report today. I did see Tesla had 3 or 4 stock splits. Nvidia will have 5 to 6. Yeah, Nvidia's had some other stock splits previously. Let's see. Somebody said I can only buy Nvidia below 90, not raising my average. Jay, I'm not mad at you. If you're stuck there and you got a reason to be stuck there, I'm cool with you. Somebody said I'm going long term on Nvidia and my other positions, but I keep an eye on the ones I might sell. Not bad. They shouldn't cut nothing until home prices decline. Well, listen, when they start cutting, what's going to happen with what's going to happen to mortgage rates, right? Mortgage rates going to come down. People are going to start buying more houses, and home prices is the one that's going to be stuck, like Bree said, right? Home prices are way up. But my thing is, are home prices going to come down to what we think they'll come down to? I don't necessarily see that happening. I could be wrong. I don't see it happening, right? Somebody said, yes, the Fed doesn't even need to have a meeting. They can do it at any time. Sherlock, you're probably right, but they'll usually get together and have their meeting. Let's see. AI is the next industrial revolution. It's a long game, but I can't see anything else that will blow up like tech in the next 10 years. I tend to agree with you, Tony, right? Tend to agree with you, right? The Feds won't activate a cut. Personally, I don't think the Fed will do anything with it until September. And I think in September, I think we could be looking, if we see the market continue to do what it's doing, and then we get another, are we going to get another report, jobs report? I think we will get another jobs report before the next Fed meeting. They like to have the jobs report done before the Fed has their meeting, so the Fed can use that data for their decision making, right? So typically you'll see a jobs report come out, not all the time, but sometimes you'll see a jobs report come out right about the same time that the Fed makes their decision. But in September, if we see a jobs report that is 4.4, I say 4.3 to 4.4 in terms of unemployment, and at the same time, we see this continued volatility in the stock market, I think we could be looking at a 50 basis point cut, half a percentage point cut from the Fed funds rate. That'll be the first cut in 13 months. And I think if you can get to the point where you have the first cut in 13 months, I think that's going to do wonders for the economy, wonders for the stock market. You'll see some serious growth. But right now, while you're not seeing that growth, remember, guys, every 2 or 3 years, the stock market has a I won't say a crash, but it has sort of a crash/correction every 2 or 3 years. Every like 9 or 10 years, it has a big one, right? We had a big one in 2009. We had so we're overdue for a large correction in the stock market. If you've only been investing in the last 3 or 4 years, 2 or 3 years, you haven't seen a large correction. But what you see today in the stock market is a precursor to what could be a larger correction. You've got to practice handling this without your emotions, without your stress, without your anxiety. You got to practice handling this in a way that is more of a long-term investment outlook. And it's going to try your patience. But that's what happens if you've been in the stock market for a long time. All right. Think about just 2 years ago, 3 years ago, right? S&P 500 was down 19%. Everybody lost money. If you had $500,000 in the stock market, or let's say in an S&P 500, and everything went $500,000 and everything went down by 19% over the course of a year, that means next year you only had $410,000 in there, whatever that may be. You had a lot less money. So it happens. And the more money you have invested, the larger the swings in terms of your portfolio when we have these market corrections. Let's see here. ETFs are best, said Omanike. ETFs are best. I'm not mad at you. There's nothing wrong. I'm a big, most of my portfolio is not in individual stocks because of the risk. And I don't like the risk. And I don't want to sit and watch stocks. And I'm not that good to be picking stocks all the time, all day, every day. Because again, most professionals don't get it right. They don't get it right either. So I'm not a professional. I'm supposed to know. Nah, I'm more of an index fund ETF person as well. But I do have some single stocks. Matter of fact, what we're doing on the other platform, right? Over on Patreon, Smart Money Bro on Patreon, we're digging into individual stocks. We started with about 5K. About 5K is what we got. And we said, we're going to walk this thing through, come up with a plan. And we've done some videos over there for you guys to take a look at. If you join us, there's a link in the description box below. But over there, we're digging in. We're trying to go grow a portfolio over there. And feel free to come over there and check it out with us. Somebody said, has the Fed ever raised or lowered the interest rate between the routine FOMC meetings? Yes, absolutely. We just spoke of one. Last time was in March of 2020 at the start of the pandemic. When the pandemic started, the Fed immediately had a meeting other than their normal meetings, an emergency meeting, and they lowered the rate. Why? To stimulate the economy, to get people out there. 6 months later, they were handing out stimulus checks, right? And they were adding money to the economy. They were printing money to go into the economy to stimulate. They were buying bonds. I'm sorry, buying bonds. They were buying bonds from banks. The Fed was buying tons and tons of bonds from banks. They were adding bonds to their balance sheet. They were buying bond when the Fed buys a bond from a bank, the Fed gives them cash. Why does a bank need cash at the start of the pandemic? Why did the banks need cash? Why? Because the banks and the Fed work together to make lending super duper 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 cheap. Why would they want to make lending super duper 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 cheap and take that Fed funds rate and move it way down to near zero at the start of the pandemic? Why would they do that? Because they were trying to get people to get out and spend, because nobody was out shopping because of the pandemic. So when nobody's out shopping, how do you get people to get out there and spend money? You give them a bunch of money in the form of PPP loans and stimulus checks. You put a bunch of money in their hands, and then you go out and put a bunch of money into the banks, and you make the lending rate really, really low. What does that do? That incentivizes people to go out and spend money. And then you wonder, many people wonder, well, why are we having this incredible inflation in 2022, 2023? What's going on? Where did this inflation come from? The inflation came from the fact that the Fed printed money, bought bonds from banks. They added bonds to their balance sheet, and they gave banks cash and lowered the interest rates and put money in your hands. Next thing you know, you're out spending. And what happens when people spend? Demand goes up. What happens ultimately when people spend and demand goes up? Prices go up, right? So you're wondering, why are we having all this inflation? It's because of what happened several years ago at the start of the pandemic. That's just how the whole thing rolled out, right? But then if you go to Fox News, they're going to tell you one thing. You go to CNN, they're going to tell you something else. MSNBC, they're going to tell you, oh my gosh. So you got to watch what news you listen to and try to understand how this whole thing works for yourself, right? Let's see here. I'm going back to the chat. True that. Cuts will cause housing costs to rise higher. Send me some boom, boom, boom. Cut my mortgage rate. Let's see. Good. Hey, Corey, thank you so much. I appreciate that, Corey. Guys, do me a favor. I haven't said it, but hit that like button for me. Smash the like button. We saw today, and this is why it's urgent, an Nvidia stock crash. I call it an Nvidia stock crash, but it's really a stock crash altogether. Lots and lots of stocks are on the red. If you looked at a heat lamp or heat vision of the S&P 500, it's all red, right? It's all red, right? And the question becomes, should the Fed make that move and go ahead and do it at an emergency rate cut? I don't think they should, and I don't think they will. Here's why I don't think they should. You got to let the market do what the market do. You got to let the market do what the market do. Not proper English, but that's okay. You got to let the market do what the market is supposed to do in terms of corrections. Right? Now, I don't think the Fed is going to bow to any pressure, right? But you never know about the Fed. Somebody said, did Trump try to blame the stock market down on Kamala? and and then Kamala would blame it on Trump, and then Trump will blame it on Biden, and Biden blame it on Trump, and boom, 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 boom. Look, these become talking points for politics, right? Talking points for politics. Let's see, AVGO or Broadcom almost got me back to green. Fantastic. Always got to be careful what you buy. Always, always. Let's see. Somebody said no rate cuts unless another pandemic or another national emergency. We'll see about that. Let's see. Palantir had a good earnings report. We said that earlier. Let's see if we got, and I'm way behind. Yeah, I'm about 6-7 minutes behind. Let me catch up to you guys. Let's see here. We need a major correction across the board. Listen, the market will correct itself. That's why I don't think the Fed should do anything other than a quarter or half percentage point rate cut. 25 basis points, I think maybe in September might be a good thing, right? Maybe. Somebody said take advantage of VOO. That's the S&P 500 Vanguard ETF. Take advantage of that being lower. Absolutely. Guys, you got to do me a favor. Come on now. Do me a favor. Hit the thumbs up button for me. All right? Hit the thumbs up button for me. Take a look at Mint Mobile in the description box below. Take a look at those. I use Mint Mobile, like it very much. One of the very, very few partners I have on these videos. Also, a partner of mine is a StreamYard. You know, StreamYard's like super duper simple. It's one of my favorite pieces of software that I use because it's so easy to use. It's crazy. I can't believe it's literally a 4th or 5th grader can use StreamYard. That's how easy this stuff looks on the backside of this. But the point is, guys, oh, by the way, thank you, Mrs. Moore. I appreciate you there as well. Let me see something here. I think these things still work too. Yeah, check us out on smartmoneybro.com as well, guys, when you get a moment. Let me finish looking at some of the chats. You guys got a question? Put a Q in there for me. And again, guys, this is something to watch. I'm not telling you to sit and watch your stocks all day and all that good stuff. You can if you like, if this is something that you really like and you want to check them out all day. I don't like watching stocks all day, right? I really don't. But I do like, dollar cost averaging plus, meaning that you can I like dollar cost averaging into anything, right? Stocks, ETFs, index funds. But if you have a little bit of reserve and you see a dip, it's a good chance, good opportunity to take advantage of it, right? You always want to take advantage of it as an investor, right? So let's see. Somebody said buy the dip. Absolutely, buy the dip, no doubt. I still keep Nvidia and expect a further trading down to be lower than 100. Now, how many of you in the chat here are going to say, "Hey, my strike price is under 90 or below on Nvidia"? How many are going to say 90 and below is your strike price? Let me know in the chat real quick. I want to see what our risk tolerance level is. 90 and below, I'm buying, and I'm buying big is the question that I have for you guys. Is that you? Is that not you? For me, I'm dollar cost averaging into Nvidia, right? I'm not looking to make any special big plays. I'm not going to pull off and get 200, 300, 600, 1,000 shares if they drop below X, right? How many of you are under 90 and below is your strike price or your target price for Nvidia when you actually jump in heavy? Let's see. Somebody said right here, 90 and below, validated. Okay. Let's see. Somebody said it did hit 90. I think it hit 92 was the low I thought I saw. I could be wrong. Somebody said anything below 90. For me, my average is 90.42. Interesting. 80 and below, said store CEO. 80 and below? whoo, you might be waiting a while. We'll see what happens. Look, pay close attention to, because Nvidia could dip. Somebody also came back here and said, question, what is a good amount to invest in the Vanguard S&P 500? Lovely heart, it depends on a lot of issues, okay? Depends on, lovely heart, how old are you? Do you have any other investments? Is this extra? Do you already have $750,000 somewhere else? Do you only have $30,000 somewhere else and you're 65 years old, right? So, what is a good amount all depends on a lot of different factors and variables because everybody's situation is different, right? So, and you also might want to think about allocation, lovely heart. What that means is, do you want to have 50% of your money in the Vanguard S&P fund and maybe 50% somewhere else? Maybe a bond fund? Maybe do you want to have 20% of your money in cash? How are you allocated, like on a pie chart, right? Do you want to have 100% of your money in a Vanguard S&P fund, S&P 500? Cool. Or do you want to have 90% in the S&P 500 and maybe 10% in BLV or BSV? Those are short-term bond funds that are ETFs over at Vanguard. How do you want to split your money up? Do you want to be a little more risky and have 95% of all your money in an S&P 500 ETF? Or do you want to split it up differently? Do you want to have 70% in the S&P and 20% in individual stocks and 10% in bonds? These are all the things that you got to think of. So to answer the question, what is a good amount to invest in the Vanguard S&P 500 in a fund? It all depends on a lot of different variables. I hope that answered your question. Probably not, but I gave it a shot, right? Somebody said anything below 90. We said that already. December, 80 and below. We said that already. Let's see. VOO is what I meant. Got you. I know what you meant. What's your price prediction for Nvidia August 28th? Now, that's a great question. Let me highlight that because that's really important. What Gene asked is, what is the stock prediction as we get closer and closer to earnings, right? So what is Nvidia's earnings going to look like? Now, listen, we were saying a month ago, those earnings are going to look good. Those earnings are going to look good. Well, with some of the slowdown that we see, are those earnings going to look good? You got to ask that question because those earnings make a big difference in terms of the pre-price and the post price, right? So in other words, we might go down to 95. We might be at 95 or 100 by the time per share by the time the earnings report happens. But if there's a favorable earnings report or the expectation of a favorable earnings report, you might see Nvidia go back up to 115, 130, 135 around the time of the earnings reports, before or after, right? That's something you got to think about. Again, we got to ask this question. Was the AI thing for real or was the AI thing not for real? So in terms of a price prediction, I have a feeling that the earnings report will be fairly decent for Nvidia. And we may see an uptick around the late August timeframe. But again, remember, before, well, it's going to be after actually. So after the earnings report is when we're going to get the Fed to make a decision on their Fed funds rate, right? So I don't think the Fed funds rate is going to pay. Now, if the Fed comes along and says we're going to do an emergency cut, everything's going to start looking more favorably. I just don't see that happening because I think the market year to date really has been too strong for the Fed to come in and do something like that and cut rates. But we'll see, right? Get earnings in, like I say, about 4 weeks or so. We'll see earnings, right? Let's see. No, it's buying season. I agree with you. It's buying season. Look at these dips not as a problem, but look at these dips as an opportunity, right? You gotta sort of you have to sort of approach the stock market and long-term stock market investing opposite of your human nature, right? Human nature is to get, nervous, not sure what's happening, a little bit startled, scared, and panic. But right, but like a Warren Buffett said, right? Everybody, what did Warren Buffett say? Somebody help me. When everybody panics, be greedy, and when everybody's greedy, be a little nervous or panicked, right? I think he said something like that. And everybody got really greedy on Nvidia. We know that. They got really what they call irrational exuberance set in. People that had never bought an individual stock in their life, and I know this because I've talked to a couple of dozen of them, never bought an individual stock in their life, went out and bought Nvidia. So there was a lot of irrational exuberance around it, right? And probably had it overvalued along with some other stocks in the AI space. But again, AI or tech space, tech is very volatile and it is cyclical, comes in waves, right? Let's see here. Am I misremembering 3 cuts? Yeah, everybody said 3 or 4 cuts at the beginning of the year, right? Fed even came out and gave an indication that they'd start cutting rates. Still haven't cut them. And this is why people are saying the Fed is being stubborn. It's making a mistake. They should have been cut rates, right? Be fearful when others are greedy and be greedy when others are fearful. Got it. Listen, guys, I hope this was helpful, at least for us to dialogue about the fact that, hey, the market is down. Don't panic, but it's something that you should be paying attention to. That's why I put urgent in the title, because you have to pay attention to whether or not the Fed does an emergency rate cut. If they do, we'll see a quick rebound of the stock market, because then that's favorable news to a lot of investors, right? And you've seen, guys, let me say this too. You've seen a lot of sell off. We've actually seen the bond market, the yields on bonds go up a little bit as we see a shift of money out of the market, right, to more fixed assets. We've seen that kind of happening recently. I think we're going to see it a little more in the next couple of weeks as well. Meaning I don't think the market's going to recover all of a sudden and have a record-breaking week or a record-breaking day. I don't see that happening for a little while, right? I really don't see that happening for a little while. And people sell off. Why do they sell off? I'm not talking about the big executives, right? But why do larger institutional investors sell off, or larger retail investors? Why do they sell off? They sell off because they don't want to take the cut in their money. So they don't see a 10% downswing in their money. They go and park their money at more fixed assets where they can get 1%. Look, 1% on your money is better than negative 10% on your money. The problem is, for most of us regular everyday retail investors, we can't play the game of jumping in and jumping out because we miss a lot of gains when we jump in and jump out. That's why we tout and say dollar cost average, putting a certain amount in at certain intervals constantly, no matter what the market is doing. $100 a month, $200 every 2 weeks, every time you get paid, $400 every once a week, whatever it could be. Just dollar cost average in. And don't worry about whether the market is down, whether the market is up, because if you got good, solid individual stocks that you like and you believe in, and they have growth, they show good fundamentals, good qualitative and good quantitative fundamentals, then you're just buying more shares. When you dollar cost average, you're just buying more shares at a cheaper price. Sure, Costco, which is trading at $800 something dollars, okay, they dipped down to $600 something dollars. Okay, that doesn't necessarily change the fundamentals of Costco. It doesn't necessarily change the amount of debt they have, or their debt to whatever ratio. It doesn't change necessarily their earnings per share, so to speak. It'll change that a little bit, but it doesn't change some of the fundamentals of the business. It just means they're cheaper now, and you got to look at that. Now, also, please understand and know how this actually could change some of the fundamentals, right? So if you're a stock that sells consumable goods, like let's say Nike, right? If less people can afford a house and less people can afford a car loan, then probably less people are going to be out there using discretionary money to buy Nike branded shirts and Nike branded shoes. So maybe Nike could be affected. But every sector that you're investing your money is going to be affected by these things in the economy a little bit different, right? So tech is going to be affected different than energy, right? Energy is going to be a little bit different. The financial services, the MasterCard, the Visa, the Wells Fargo, the Citigroup, whatever it could be, JP Morgan Chase, they're going to be affected a little bit different than transportation, right? And transportation is going to be affected a little bit different than tech. Tech is cyclical. Transportation is non-cyclical, I believe, right? So always keep that in mind with this is why you got to be careful if you have too many individual stocks. And if you're only invested in individual stocks, you want to have a good range so that you have some diversification. But at the same time, if you have too many, then you're keeping up with 100 stocks. And it's hard to keep up with 100 different businesses, right? So I hope I was able to give you guys something to think about, something to ponder. Please do me a favor, hit the thumbs up button. Share this information with somebody that you know. Check out some of the stuff that we have in the description box below. Go check us out on smartmoneybro.com. And again, check us out over at Instagram. I'm trying to see about how it would be to, kind of get a little more traction on Instagram, right? So check us out at Smart Money Bro over there, guys. Quick question before you go. I got you, Jeff. Don't trip, Jeff. I got you. Right there. We right there. Let's see. Quick question. What sector, if any, do you think is recession proof, depression proof? That's a good question, Jeff. I think a sector like I mentioned earlier, energy is one. Think about oil, ExxonMobil, Chevron. People always have to use oil. When the market was way down in 2022, guess who was having record profits? Energy or oil, ExxonMobil, Chevron, right? So anything that's non-cyclical is usually going to be a sector that is sort of impervious to recessions. It doesn't mean they'll never have their down, right? As a sector, doesn't mean they'll never be down. It just means that when things go bad for us as consumers, not necessarily goes bad for them in that sector. But I think energy, oil, all those things, I think those are staples, right? Food, anything you can, think about food, right? Food manufacturing. I'm not talking about necessarily Taco Bell, right? I'm talking about food or the manufacturing side of food. It's certain industrials, right? Those type of things are typically a little bit more recession proof. Just my opinion, Jeff. I hope that answered your question. I appreciate that. Hey, Mrs. Moore, appreciate you, Jay. Appreciate you, Validated. Appreciate you. We got two J's in here. Appreciate you, Walla Mala. Appreciate you, Hermes. Appreciate you, Kentucky, Hillbilly. Let's see, Lady Kia. Good to have you here. Consumer staples. Yes. Consumer staples, she said. Absolutely. That is definitely one that you cannot, that doesn't flow. It kind of is always going to be there for the most part because everybody got to always eat, right? Everybody got to eat. Everybody got to run it to Costco or Sam's Club, whatever. Everybody got to go to Walmart and grab something, some a pillow or whatever they need, right? Or whatever for the car. They got to go there and grab food. So those consumer staples are always going to be there that they don't typically, drop down. They're depression proof or recession proof. So I appreciate you guys more than you know. This channel wouldn't be what it is without you guys. So big kudos to you. And I appreciate you guys helping each other out in the chat. Thank you so much. Very lively chat. Listen, drop me a comment in the chat. Right? All right, Nigel, you guys have a blessed day, and I hope I was able to help you with something. As I always say, the best person to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.